Anonymous.
Retailer.
Retailer. Anonymous. Retailer.
Hello, anonymous retailers. I'm Jason from anonymousretailer.com. We are 6 months into 2026. That's how long the American consumer has been absorbing higher prices, rising uncertainty, and a constant stream of headlines telling them to be cautious. And they kept showing up. They didn't spend the same way. They didn't buy the same way, but they kept showing up. Which brings us back to the same question we've been asking all year. Has your store been worth the trip? When we started this year, we built these quarterly outlooks around the simple question. Is it worth the trip? Q1 was about a customer becoming more selective. Q2 was about an operating environment becoming less forgiving. Now we arrive in Q3. This isn't a new story, it's the next chapter. Today, I want to answer 3 questions. How did we get here? Who is the customer walking into our stores right now? And what decisions actually matter between now and Labor Day? Let's start by looking backward, not to relive the first half, but to understand how it produced the customer standing in front of us today. Here's how we got here. January didn't look particularly unusual. The foundation underneath that optimism had already begun to shift. By January, retailers had already spent months absorbing higher landed costs from the tariff environment. The consumer had already been living with elevated prices. The adjustment wasn't beginning, it was becoming permanent. When we recorded the Q1 outlook, I called it a precision quarter instead of a volume quarter. I said the consumer wasn't disappearing, they were becoming more selective. Looking back now, that read was accurate. But what I underestimated was how fast the behavioral shift had already taken hold. The consumer stopped making automatic decisions. Every purchase became deliberate. Every trip required justification. Every discretionary dollar started competing against something else. That's a behavioral change. And behavioral changes last much longer than economic cycles. Inflation eventually comes down. Interest rates eventually change. Consumer behavior has a way of sticking around. Once somebody spends 6 months learning to compare prices, delay purchases, and ask themselves whether something is worth buying, that doesn't disappear because next month's CPI report comes in a little lighter. It becomes the new normal. That was the real story of Q1. Not weaker demand, a different decision-making process. There was something else Q1 reminded us of. The fog of Q4. Holiday sales are strong. Traffic is high. The register is ringing. And somewhere during all that momentum, it's easy to convince yourself the pace you're operating at is permanent. It never is. January has a way of removing that illusion. The businesses that struggled most in Q1 weren't necessarily bad retailers. Many of them simply allowed the momentum of Q4 to influence decisions that should have been made with a much calmer perspective. That lesson matters because it doesn't just explain Q1, it explains every buying decision we're making heading into the second half of this year. Then came Q2. If Q1 was about behavioral change, Q2 became about environmental change. Not because one event happened, because several happened almost simultaneously. The geopolitical conflict in the Middle East reshaped energy markets almost overnight. Oil prices moved. Gas crossed $4 a gallon. Freight markets immediately began repricing risk. Container rates climbed. All at the exact same time inflation reversed direction. 5 consecutive months of acceleration. Retailers absorbed pressure from multiple directions at once. Higher landed costs, higher transportation costs, a consumer whose purchasing power was becoming increasingly constrained. Individually, none of those variables are unfamiliar. Specialty retailers have lived through inflation. We've lived through freight spikes. We've lived through tariffs. What made the first half of 2026 different wasn't one variable. It was the accumulation. pressure layered on top of pressure. Every month asked retailers to adjust to something new before they had fully adapted to the last thing. And yet, through all of it, the consumer kept showing up. That may be the most important observation from the first 6 months of the year. Not because the consumer ignored the environment. They didn't. They absolutely changed, but they never stopped participating. The customer didn't quit. They recalibrated. And that's a much harder customer to serve. They're informed before they arrive. They've already compared alternatives. They already have an idea of what something costs. They're making fewer purchases, but when they decide to make one, they're serious. Let's take a look at how the pressure is stacked. One of the mistakes we make in retail is looking at costs one at a time. Freight goes up, tariffs change, inflation accelerates, energy spikes. We tend to analyze each one independently. The problem is your P&L doesn't experience them independently. It absorbs them all at once. And that's exactly what happened in the first half of 2026. Pressure stacking on top of pressure. Each layer made the next one more difficult to absorb. And eventually, those costs found their way to exactly one place: your floor. Let's take a look at these CPI increases for the year. January, we came in 2.4% over the previous year. February reported a gain of 2.8. February is also when the war in the Strait of Hormuz broke out. March came in at 3.3, April at 3.8, and May topping out at 4.2. That's a 4.2% increase in inflation over the same month last year. 5 consecutive months, one direction. That's how inflation changes behavior. Not all at once, incrementally. One grocery trip, one gas fill up, one utility bill. Eventually, the consumer doesn't need a headline to tell them prices are higher. They're living it. And once they start living it, they start adjusting. Not because an economist told them to, because their checking account told them to. The consumer didn't become fearful. They became disciplined. Fear causes people to stop spending. Discipline changes how they spend. That's exactly what we've been watching. One other number deserves attention. Gasoline up more than 28% year over year. Gas is unique. It's the most visible price in the American economy. Nobody checks the price of toothpaste every week. Everybody checks the price of gasoline. When gas moves, the consumer feels poorer before they've even looked at the rest of their budget. That's why it matters to retailers. Not because you sell gasoline, because it influences how your customer feels before they've ever walked in front of your door. There's another chart I want you to see, and I think this one matters even more. Container rates, China to the US West Coast. Before the conflict, containers were roughly $1,880 per container. Within weeks of February 28th, that became $2,430 per container. Today, we're sitting above $5,741. Think about that for a second. Nothing inside the container changed. The jacket didn't change. The running shoes didn't change. The cost to move it changed. And every one of those dollars has to go somewhere. Sometimes the vendor absorbs it. Sometimes the retailer absorbs it. Usually it's shared. There's another statistic on this sheet. 1 in every 3 containers moving around the world today is moving back empty. Ships aren't transporting products. They're repositioning equipment. That's inefficiency. And inefficiency always costs somebody money. That's why I titled the chart, "The Cost Before It Hits Your Floor." Because by the time you're debating retail price, the biggest decisions have already happened. The freight was booked. The tariff was applied. The purchase order was written. The inventory was committed. Everything after that is damage control. One more variable worth naming, tariffs. Here's the simplest version I can give you. The legal framework changed. The cost structure didn't. There have been court decisions, policy announcements, new deadlines. The American Apparel and Footwear Association reports tariff rates on footwear and apparel runs over 5 times higher than on all other U.S. imports. The Footwear Distributors and Retailers of America is projecting retail price increases of 30 to 50% on imported footwear, depending on origin and category. Section 122 expires July 24th. Whatever replaces it is being built right now. Prices moved with cost, that's established. The consumer absorbed those increases and arrived at a 74-year sentiment low. The operator absorbed them and arrived at the most pessimistic business segment in the country, per the National Federation of Independent Business. As for the Strait of Hormuz, an MOU was signed at Versailles on June 17th, a framework to negotiate, not a final agreement. Technical talks are underway. Mines are still in the water. About 40 ships are transiting daily against a pre-war average of 110. The 60-day negotiating clock runs through mid-August. That's directly through back to school. Gas prices are falling heading into July 4th. That's real, but rockets go up fast and feathers come down slow. The consumer who changed their behavior at $4.49 doesn't snap back the moment the gas price moves. Progress has been made. The negotiation is underway. We're going to watch how this plays out. Let's take a look at the consumer we have today. So with all of this as the backdrop, who's the customer that's walking in our store today? I think one of the biggest mistakes retailers make is believing they're still selling to the customer they had a year ago. They're not. That customer has evolved. The customer standing in your store today has already done most of the shopping journey before they arrived. They've searched, compared, read reviews, watched videos, asked AI. By the time they arrive, they're no longer deciding whether to buy. They're deciding where to buy. Stores used to be discovery. Today, they're confirmation. The decision started somewhere else. The store is where it gets validated or abandoned. That's why worth the trip has become bigger than a marketing phrase. It's become the operating question. Now let's talk about the other side of the story. Because if you spend enough time watching financial television or scrolling through headlines, it's easy to believe the American consumer has disappeared. The data tells a different story. And the correct parallel is COVID. March and April 2020, the worst 2-month collapse in recorded retail history. Down 8.7%, then down 16.4%. And then the consumer came back harder than anyone projected. Not because the environment got easy, because the American consumer is built differently. Consumerism is a structural sport in the United States. It's roughly 70% of GDP. That doesn't change. 6 months into 2026, that same consumer has absorbed a war, $4.49 gas, a 74-year sentiment low, 5 months of accelerating inflation, negative real wages, and a freight market shock embedded in every PO placed this year. And the real volume is roughly flat. They didn't collapse. They recalibrated and kept moving. The Michigan consumer sentiment hit 44.8 in May, the lowest reading in 74 years. June came back to 49.5, still the second lowest reading in survey history, still 13% below pre-war levels. Over half of consumers are still citing high prices as the top pressure on their personal finances. The consumer isn't back, they're off the floor. That's a meaningful distinction. Higher thresholds reward better retailers. Weak operators compete on price. Strong operators compete on confidence, experience, knowledge, trust. Those things become more valuable, not less, during difficult environments. Demand didn't disappear. The threshold moved. Here's the retail therapy. The customer who walked into your store this quarter already made one important decision. They decided you were worth visiting. Don't waste that decision. Train your staff to confirm what the customer already believes. Know the product. Know the alternatives. Know why yours is different. The transaction isn't about convincing somebody to buy. It's confirming they came to the right place. Let's check in on how Q2 played out. Q2 handed us 5 demand events, 5 chances for your floor to tell you the truth. Easter, Mother's Day, Memorial Day, graduations, and Father's Day. We tend to remember Q2 by revenue. The better retailers will remember it by signals. Easter asked whether your spring transition happened because the calendar said it should, or because your customer was already telling you they were ready. Those aren't the same thing. Mother's Day tested gift merchandising and emotion. Did customers trade up? Did they add accessories? Or did they grab one item and go straight to the register? That tells you how much confidence they have in discretionary spending. Memorial Day told you where summer demand actually lives. Not where buyers hoped it would. Not where the vendor told you it would. Where customers actually spent money. The cash register has no emotions. It simply reports. Graduations quietly tested the middle of the market. Gift purchases, budget-conscious purchases on one of the best reads we had all year on the deliberate consumer. Did they still buy, or were they simply more intentional around price points? Father's Day answered one question: can we close? When someone walked in knowing exactly what they wanted, did your floor make that purchase easier or harder? Managed with precision, those 5 events built momentum. Managed with optimism, they built summer overhang. How did you come out? Here's the retail therapy. Don't remember Q2 by holidays. Remember it by signals. Pull the velocity data from every one of those demand events, not the revenue number, the unit velocity by category. The categories that accelerated, the categories that stalled, your floor already gave you the answers. The operators who study their signals enter the holiday season with confidence. The operators who remember only the revenue will spend the next 3 months guessing. The operators who are listening enter Q3 clean. Confirmed velocity, right inventory position, clear picture of where to put the dollars. The operators who are optimistic enter Q3 carrying spring goods they need to move, margin to recover, and a back-to-school buy already compromised what didn't sell by June. We now know 3 things. We know how we got here. We understand the pressure the first half created, and we understand the customer standing in our store today. Now comes the part that actually matters. Q3 isn't asking retailers to predict the economy. It's asking us to make better decisions than our competitors. And I think there are 4 decisions that will determine who enters holiday with momentum and who spends October trying to recover from July. Decision 1, what do I do with inventory that didn't sell? The temptation is to wait. Maybe it'll turn. Maybe customers finally notice it. Every week that inventory sits on your floor, it's competing against inventory that's already proven it deserves your investment. More importantly, it's tying up cash that should be buying products your customer has already voted for. The markdown isn't the mistake. The buy was. Markdowns simply reveal buying decisions that didn't work. The faster we acknowledge that, the faster we move forward. Here's the retail therapy. Let velocity create opportunity, not optimism. Clearance isn't a Q3 problem. It's a Q1 and Q2 buying decision showing up late. You didn't fail at a markdown. You failed at the buy, betting on depth before sell-through earned it. Convert stale inventory back into cash. Cash can go back to work. Dead inventory can't. The real fix is buying lighter next time and letting velocity tell you when to go deeper. Decision 2. Where does my customer actually want to transact? We build assortments around where we hope customers will spend instead of where they've already shown us they're comfortable spending. 15 months of elevated prices have recalibrated where your customer transacts. Retail prices moved with costs. That's established. The question now is whether the customer landed with those new retail prices. Apparel prices at the register are up 4.2% year over year. The consumer absorbed that, but they've also adjusted. Fewer units, tighter decisions about where their dollar goes. Your average selling price isn't simply measuring transactions. It's measuring customer comfort. It's telling you exactly where your customer is comfortable opening their wallet. Your customer has already voted. Read the election results. Here's the retail therapy. Pull your ASP data from last back to school. Where did your customer transact? That's your volume zone. Not what you wish it was. Buy to that number. Let velocity create opportunity, not optimism. Buy light, buy to proven zones. Let sell-through tell you where to go deeper. The floor already knows where your customer wants to do business. Your buy should confirm it. Decision 3, back to school as the holiday canary. Back to school is the most important Q3 demand event. But in 2026, it's doing something else. It's the first real read on who your holiday customer is going to be. 70% plan to shop in store, down from 79% last year. A 9-point drop in a single season. 73% will use AI during the search process. The customer showing up in your store for back to school has already researched, compared, and filtered. They're not here to browse. They're here to confirm. That's exactly who walks through your door in November for holiday season. How they shop back to school is how they'll shop holiday. Read it right, and you know your holiday customer before the season starts. Here's the retail therapy. Before summer ends, pull your back to school data and your holiday data from last year by category, unit, velocity, and ASP, not just revenue. Line the two seasons up. Where did your customer transact? What did they cut? In store or online? That data is your holiday blueprint. You'll have a close-in last look at a high-volume selling area lined up against last year's selling data and compare the strength between the two. The operators who read it now won't be guessing in October. Decision 4. How much do I commit to the holiday pipeline? Consumer sentiment is historically low. The macro is uncertain. The instinct is to wait. Wait feels safe. Sometimes it's the most expensive decision you'll make all year. The holiday import window is June through August. It's open right now, and it closes whether you're ready or not. June saw retail imports surge up 14.3% year over year. July and August are forecasted down 8% or more versus the 2024 front load peak. Fewer units scheduled to arrive for holiday. The operator who committed the right amount of goods on their holiday orders is in a different position than the one who waited. Here's the retail therapy. Your holiday open to buy decision is being made right now, whether you're making it consciously or not. Look at what your velocity data is telling you. If the turns support it, commit the capital. If they don't. Make that call from your floor, not from a sentiment index, not from a headline, not from a negotiation happening in Doha. Let's take a look ahead. The calendar is about to start working in our favor again. 4th of July, patriotic, high frequency, proximity driven. Gas prices are falling heading into this weekend. Local wins this one. Summer travel season. Airline fares are up 20.7% year over year. Consumers trading down to shorter, closer trips. If your market is near a regional travel destination, this is your moment. Back to school. The floor is being set right now. Maybe it's already out. Labor Day, the close of summer, the last read before the holiday narrative locks. What's on your floor and what's moving tells you everything about where Q4 is headed. Every one of these demand events is a preview. Pay attention. The consumer returning to stores in 2026 is not the post-COVID consumer. They already know what they want, what it should cost, and what the alternatives are. They're not there to decide. They're there to confirm or walk. Every visit is an audition. The open questions Q3 has to answer. Does the straight negotiation produce results before Labor Day? Does the gas price pullback hold? Does Section 122 get extended past July 24th, replaced or expire cleanly? Does the sentiment bounce continue into back to school? We're watching. The first half of the year gave us information. Q3 asked us to do something with it. Operate at the pace the market is actually giving you. Let velocity create opportunity, not optimism. Trust your floor. Trust the signals. Buying set the table. Did you buy right? Right categories? Right ASP alignment? Right timing? Or did you buy what you loved? Marketing made the case. Did you give the customer a specific reason to make the drive or ask them to gamble their trip tax on hope? Selling closed it. When they got there, did your floor deliver? Did your people close with conviction or did they leave with nothing and not come back? The environment is moving. Gas prices are falling. An MOU has been signed. Technical talks are underway in Doha as we record this. The mines are still in the water. The freight market is still pricing a war premium into every container. We're watching how all this plays out. What we know right now is what your floor is telling you. Start there. The American consumer is durable. They absorbed a war, $4.49 gas, a 74-year sentiment low, 5 months of accelerating inflation, negative real wages, a freight market shock embedded in every PO. They made the trip, all of that, every data point, every headwind, every number in this episode. That's what it costs to get them in your door. Are you worth the trip? Demand didn't disappear. The threshold moved. I'll see everybody on the next quarter.
AnonymousRetailer.com